Welcome back, everyone. Thank you for making it back in time. I don't need to ask if you've been able to continue the conversations we've been having here. I think the evidence is clear, and that's wonderful, and it's one of the main reasons for this conference today. But let's get back to our main agenda. We're going to turn our attention now to a critical examination of economic policies and their impact on the continent's development trajectory. I'm sure we could all come up with at least one policy we can think of implemented over recent decades that has had a negative impact on growth in African countries. And there is an urgent need to explore new approaches that can unlock the continent's potential. So I'm pleased to introduce Gibran Qureshi, Head of Africa Region's Economic Research at Standard Bank Group, who will moderate this next panel on policy and Africa's economic development challenges. Now, Gibran leads an award-winning multi-geographical research team, and he was recognized as one of Kenya's top 40 under 40 professionals. His deep knowledge of African markets will guide this important conversation about strategies that are being developed both from public policy and private equity perspectives. Ladies and gentlemen, please welcome Gibran.
Thank you very much for that kind introduction. Very excited to be hosting this panel today. I'm going to invite some of my panelists to get us kicked off. We're very excited to be hosting the Deputy Minister of Finance, Dr. David Masondo, in South Africa. Dr. Masondo has actually been he's an African National Congress National Executive Committee member and is serving in the Economic Transformation Committee and has served in various positions of leadership. He read his PhD at NYU in the USA with his thesis focusing on the post-apartheid state industrial policy and investment in Southern Africa. With the Deputy Minister of Finance, we're also delighted to have Vuyo Ntoi, who is the co-managing director at the African Infrastructure Investment Managers, AIM, and he's no stranger to the development journey or financing of infrastructure on the African continent, where he was recently involved in the first IPP in Mali, been involved in a variety of IPPs in Ghana, and more famously known for his involvement in the Lekki concession company. Please join me in welcoming our panelists on stage. Thank you so much. And obviously, we've had a fantastic backdrop earlier this morning from Ghulam and all the other panelists. And our topic is mostly around anemic growth that we've seen across Africa, and how do we revive that? You know, we have a lot of public finance management challenges, but we have very high investment needs, particularly around industrializing, overcoming productivity obstacles. And I think it's quite apt to have the Deputy Minister from a public policy perspective, but also Vuyo, who's been quite heavily involved from a private capital standpoint. Of course, we are living in precarious times where the global economic environment's quite precarious, to put it very mildly. External capital for a lot of infrastructure investment is going to be quite expensive potentially for a while. Domestic savings still quite weak across many of our markets, but at the same time, we need to get economic growth close to potential, above potential, to increase employment and boost dollar earnings to avoid a lot of socioeconomic challenges that we've seen over the last few decades or so. Deputy Minister, perhaps we could start with you, and how do you juxtapose the challenges at a domestic level in South Africa in relation to savings and investment versus the state investment required in domestic infrastructure? So, I mean, from a South African standpoint, how have you viewed this over the past few years?
No, thanks. I think you're right. I think our savings are low and the investment demands are very high. And given our low domestic savings, notwithstanding the deep capital markets that we have in South Africa, it's important for us to also attract foreign capital to flow into South Africa. And I think we do understand that for capital to flow into South Africa, I mean, investors are managing risk and enhancing returns. And one of the key things that at the macro policy level, we've been working on as a fiscal authority is to put our debt at sustainable level. Debt in itself, it's not bad. The question is whether the economy can afford it. Because if the debt is unsustainable, it raises the sovereign risk premium, and that raises the cost of capital, not only to bonds, but also to equities. So we've been on the path of keeping our debt to public debt to sustainable level through managing our fiscal policy in a prudent manner. But secondly, we are at a macro policy level making sure that our inflation is low, our exchange rate is also stable, because you don't want an investor to come into a jurisdiction and there's a lot of volatility in that jurisdiction. So let me stop here, and I can talk more about what are other things that we're doing concretely to get private capital into the economy. Because also when you grow your economy, you're also setting good conditions for raising resources domestically. Because as the economy grows, your taxes, revenue increases, and you can invest that into a whole range of things, including infrastructure. When more people are employed, both the employer and the employee, they make pension contributions. So our savings pool will definitely increase on the basis of the domestic economic growth. But foreign capital is also very, very critical.
Well, thank you, Deputy Minister. Before we sort of delve deeper into private capital, which I guess we will come in and talk about, just staying with you for a minute, in terms of just economic growth and the deficiencies within economic growth, what are some of the structural or cyclical issues that you'd like to highlight, particularly in South Africa's context?
So let me start with our network industries. Our network industries have been dominated by state-owned entities. And for some time, our economy has not been growing because of the supply-side constraints, supply of electricity, freight logistics, water, skills. And we liberalize those industries in order to allow the private sector to participate. So we change the structure of our network industries to deal with the dominance of different state-owned entities. Energy is one of those in which we said Eskom cannot be the only supplier of energy. We have seen the systemic risk that Eskom posed when we had the high intensity of load shedding. Similarly, with the freight rail, we said let's liberalize the freight logistics sector, in which we allow the third parties to operate on our rail, on the ports. So insofar as that is concerned, we are doing a lot of work in that regard. I think one of the speakers earlier spoke about the importance of South Africa in importing vehicles to the continent. And I think for us, the African Continental Free Trade, it's a great opportunity for us to increase volumes in South Africa. But the key challenge that we've got to confront is the fact that the continent, or many jurisdictions in the continent, they import second-hand vehicles. So as we talk about the structures of our different industries, both in the public sector, but also in the private sector, we've got to think continentally, regionally, on how we support industrialization and have different location for specialization, because we do have comparative advantages based on the endowments and capabilities that we have as different jurisdictions on the continent. Because it doesn't help to say, let us industrialize on the continent, but our policies are not aligned. I mean, in South Africa, second-hand vehicles are not, you cannot import them. It's not allowed, but in other jurisdictions, it's allowed. And therefore, the synergy, the harmonization of policies on the continent will be quite critical. And the African Continental Free Trade provide an important basis for us to get our industrialization going.
Thank you, Deputy Minister. I think you bring some important points, particularly around the drive to industrialize. Perhaps you could also jump in. You manage one of South Africa's largest domestic infrastructure equity funds, the IDEAS fund. Can you give us perhaps a high-level overview of some of the diversified projects you've worked to develop?
Okay, thanks for that, Gibran. And it's a great pleasure to be here on this panel with the Deputy Minister. And perhaps worth mentioning that the Minister has been a very willing ear for the private markets industry in South Africa. Sorry, another hat I wear is as chairman of the Southern African Venture Capital Association. And we've had a number of engagements with the Treasury that have been fruitful to date. Just speaking to the AIM business and the funds that we manage, the Ideas Fund is indeed kind of a large domestic investor in infrastructure, and the fund is open-ended and has been around for the last 25 years. And I think largely owing to the scale of the South African pension fund market and the appetite for kind of long-dated relatively de-risked infrastructure assets, we've been able to grow the NAV of that fund to about 30 billion rand. So it's quite a dominant player in the South African infrastructure space. And that fund has been around. It started investing in the likes of the urban and long-distance toll roads, the Bokwenas, the tracks of this world. It's been involved in public accommodation PPPs, such as some of the government departmental buildings, and then also in multiple rounds of the renewable energy project. So it's I think, still the single largest investor in REAP projects, for instance. And these have largely been successful, and I think it's kind of a testament to the partnership that government and the private sector represented through funds such as ours have achieved. More recently, we've been growing into, let's call it, more private infrastructure spaces. So we are involved in digital infrastructure, and through our platforms, I think compared to the likes of CIVH, Massive, and Telkom's OpenServe, we're the third largest player in the fiber to the home and fiber to the office market. We're involved in cold storage, where we've established a platform mainly looking at providing food security in the region, and also involved in bulk freight and port logistics through at least 2 platforms that we're involved in. Another play that's kind of been a space we've played an increasing role in recent times has been in the commercial and industrial power space, where I think we are currently looking at a pipeline of between 1.5 and 2 gigs of power on a bilateral and on a many-to-many basis in the commercial and industrial power space. Again, testament to the government's liberalization and allowing the private sector to play a more meaningful role in generation. The other spaces we're looking at include grid flexibility and transmission infrastructure, so looking to play a role when that comes to market. We're involved in the commercial reuse water space at the moment through a partnership we have with the international player Suez, and we think that that's a conduit we can use for involvement in the broader water space in South Africa as well. So yeah, I think quite a few projects across multiple sectors that we're looking at in South Africa. And maybe it's worth mentioning as well that we're also a continental player. So in addition to the Ideas Fund, which invests predominantly in South Africa, we've got a Pan-African fund that invests dollar capital into projects across the continent, obviously seeking dollar returns. So the nature of the projects it supports are slightly different, and we managed to close that fund at circa $750 million towards the end of last year, together with about $200 million of co-investments. And this funding is largely from sovereign wealth funds, development finance institutions, and I think gladly also a large amount of commercial money into the space as well, which is something we've historically struggled to get. So in terms of broad interest in the Pan-African infrastructure space, I think if you've got a clear thesis on what you're investing in and it's clear to investors what the economic benefits will be, then you do get traction.
Thanks, Vio. I'm going to put you on the spot now a bit because the Deputy Minister cannot speak about other sovereigns apart from South Africa. And obviously you've got extensive experience in...
Unless I cause it
We don't want you to do that. So with your extensive experience, across the continent, perhaps you don't have to specifically name, certain projects, but just give us a bit of a snippet of some of what works, so the good, the bad, the ugly, in terms of regulatory issues. Have they improved? Has the PPP framework become a lot more robust? Pension fund reform to boost domestic savings? I don't know what you're thinking.
Yeah, I think that the key thing is that Africa is not a monolith, right? It's lots of different economies with lots of different regulations, with governments in differing kind of fiscal positions. Yes, there are broader themes that apply across the continent, but I think, and maybe let me do it by juxtaposing some parts of the continent versus what South Africa has done. So I think the beauty of the South African market that's allowed us to build the level of portfolio that we've built over the years has obviously, in the first instance, been underpinned by a deep capital market, a very big pension savings market where there's capital available to invest in the private markets. And obviously, in South Africa, there's been the recent Regulation 28 amendment, which has allowed increased allocation for pension funds to private markets, either private equity or private debt. We're yet to see a big allocation change, but I think this will come over time. I think pension funds are currently involved in trying to fill their offshore allocation budgets. The Regulation 28 change has also allowed more offshore allocations, but I do think that over time the allocation towards kind of productive private capital will increase. But moving on to South Africa and the policy landscape, I think maybe just using the REAP process as a case study, where South Africa essentially kind of set up a process that was multiple round and scaled, right? So I think it's very important. Scale is very important. Scale allows big businesses internationally to kind of, it props their ears up, and they then believe that there's a viable market of scale that they can participate in a country. And then further to that, the fact that there's repeatability, multiple rounds, means that kind of entities such as ourselves and other international players are then able to establish businesses to pursue the opportunities in country. Because if you don't win in the first round, you might win in the second round or third round. So there's kind of limited risk to establishing businesses, whereas in a one-shot process, one is not really going to establish a platform to pursue the opportunities because of the risk involved. And I think that's really been the benefit of the South African market, has been the multiple round programmatic nature of the infrastructure assets it's put out. Of course, we do complain about the pace at which projects are being released, and we think that that could happen with more regularity and with deeper scale. But by and large, I think the partnership with the South African government in getting projects off the ground has been great. In other instances, we also believe that it doesn't necessarily mean that government should be the procurer. You can have instances where government just loosens the regulatory bounds, such as with the commercial and industrial power market, where essentially government's not procuring the power, but the private sector is procuring on its own on an almost self-provision basis. And what's then happened is, because of access to grid, etc., the private sector has essentially built additional generation to go on grid. And the benefit is almost an externality from that private contracting, is that you have more power on the grid. So I think the rest of the continent in some ways, and this is, again, Africa is not a monolith. There are certain markets where we as a business will continue to contract on a government-backed project basis. The likes of Cote d'Ivoire, Kenya, for instance, where there's still a level of policy coherence with private sector participation in the infrastructure space. There are, of course, markets where we've experienced big setbacks. You mentioned the power project we did in Mali. Obviously, with the recent geopolitics, the coups, government's kind of ability or motivation to abide by the contracts it signed has been limited. Similarly, in markets such as Ghana, we've seen government reneging to the detriment of the private sector on some of its obligations around the power market. And what that means is when you come up with a power process now or next year, the private sector is not going to be there because there's no trust and credibility built. So I think the importance of building trust and credibility over time is what really can help in driving the private sector's participation. I think that's a kind of a short snippet. Is there are lots of markets on the continent where we will not do government-backed deals because government doesn't abide by the contracts it signed. But nonetheless, we still move forward on a private sector basis. So the way we see it is that the infrastructure development market in some of these markets is more commercial and industrial play. And the benefit to communities will arise almost as an externality to that private contracting, which is almost on a self-provision basis.
No, thanks for you. And as you say, a credibility deficit can become quite scarring perpetually and needs to be addressed for private investment to continue flowing. Deputy Minister, let me bring you back. You initially mentioned the continent's free trade agreement. And clearly there's been a concern that there hasn't been enough infrastructure connectivity to get that off the ground, in addition to the existing non-tariff barriers, for example. But as a public finance management expert and the role that you've had over the years, do you see a correlation between investment in infrastructure and a benefit to broader society? And the reason we ask that is there has been general concern that there's been overspending on projects that could be perceived to be white elephants.
Yeah, I think firstly, we all know the funding gap. The numbers that are being thrown around, it's around 130 billion to 170 billion US dollars in terms of the annually for infrastructure financing gap. And the problem is not money. Notwithstanding, here in South Africa, our savings rates are very low, but the problem it's not money. The first issue is, if I can ask, we know the funding gap, but if you go around and say, show me the projects, very few projects will be put on the table. So I do think that the working on the bankable projects, it's quite important. South Africa, we are drawing from the RIP program, helping departments to put together bankable projects, so that when you go around and say, please invest in infrastructure, yeah, it's a bankable project, it makes commercial sense, the returns are good, you guys who do capital budgeting, you do your cash flow, you see where the money will come from to make sure that returns are realized. So that's the first thing, that we really have to work on the bankable projects for the continent, and not just country-specific projects. I think we need to think about cross-border infrastructure. The Libido corridor is just one example. If you are to capitalize on this African continental free trade, you really need cross-border infrastructure. And if you are to attract big money, great money, not only from each sovereign, but from outside. People are looking for big tickets. They're looking for scale. If you're going to still be working on small projects, that's okay, but we also have to think about continentally, regionally, how we get private capital to move in there. But for that to happen, the incentives and the financial structures need to make sense. I mean, there's no doubt to your question about the importance of the infrastructure. If you are to be competitive as a continent, your cost of doing business have to be lower. If your infrastructure is competitive, if your freight logistics work, you're able to take things from here to the rest of the world and things within the continent, clearly your competitiveness will be increased. But that infrastructure must be affordable to the users. The tariffs with, I know industry has been complaining and keeps on complaining about the tariffs of Transnet, but we are at a point where you have to build the capacity of Transnet to even take goods from outside, and that's for that reason that we said, look, let's put the right financial structures to enable private capital to move into those structures. And Nwako is here from the Department of Transport. He can speak more about some of the reforms that we've undertaken and the things that they've done. The network statement is out to allow third-party access into rail. But the rail infrastructure itself requires a lot of revamping, and we're also calling the private money to get in there. But like I said, the incentives, the structures have to make a lot of sense. As National Treasury, we also said to sort out the metro's infrastructure, the trading entities, they've got to be separated out of the municipalities so that they can produce their own financial statement. They can go out in the market and raise money in order to boost our own infrastructure, because cities are critical for economic growth. So for me, to sum it up without getting into a whole range of reforms that we've undertaken in enabling the private sector to get into the infrastructure, the key thing for me is the right structures and the right incentive. Money is not a problem. It's what are the conditions that you're setting in place to enable the investors to generate better returns. I mean, I would not like, as wearing the other hat of being a public sector asset manager, PIC, throw money into infrastructure that is not going to generate good returns for those employees. So all these things have to make commercial sense. And one of the things of making sure that you get money to move into infrastructure, it's de-risking. We're working with the IFC now on the credit guarantee scheme, starting with the transmission, because the transmission infrastructure of 14,000 kilometers requires almost 400 billion. ESCOM itself, its balance sheet, I nearly said it's screwed, but it's challenged. The fiscal position, you know, our debt level, fiscally we are constrained. And through this credit guarantee scheme, we don't want to take a contingent liability. We say, look, through this credit guarantee scheme, let's set it up for attracting capital into the transmission infrastructure. And if it's a pilot, and if it is successful, we intended to scale it up into different projects, including our corridors, because a lot of our corridors, freight corridors, they require a lot of capital to move in there for us to boost our infrastructure, because we can only be competitive as the continent if our production costs are lower compared to other jurisdictions. That's the only way we can grow and make our economy competitive. The last point I want to make, we should also bear in mind that we're not the only ones as the continent, as South Africa, who are looking for money to flow our way. There are other jurisdictions, and some of them are politically unstable, the risk of causing any diplomatic, Turkey, for instance. Highly unstable, but they've got a rich history around attracting private capital into infrastructure. And I hear the issue about the way in which we are rated as a continent, which is a challenge, because the economies of the continent are undervalued, and the risks are overestimated, which makes it difficult for us to attract capital into the continent. But it will be important for us to move with speed in putting the right incentives, the right structures, and there are great examples on the continent, Lobido. There's another one in Gabon, as an example. I think it's done by Arise company. To your point, that you don't need government to put money into it. You set the right infrastructure. My distant understanding of that industrial special zone in Gabon is that the government said, here's a piece of land, and they gave a lot of incentive, and Arise as an industrial company, they did a lot of work there in industrializing Gabon, but together with other jurisdictions around there. So it's a question, again, of putting a number of incentives, and the continent is demonstrating how best we can do that. I'm aware of another project in Tanzania, in which it's a cross-border infrastructure project to get the private sector investing in infrastructure, because infrastructure, it should be, and it is, a backbone for strengthening our economy. And it's an asset which can withstand inflation. If you keep money, your money can be eroded by inflation. I mean, I saw in Zimbabwe. Okay, okay, let me stop there. Let me, sorry, I take it back. I did not mean it. I profusely apologize.
Thank you, Deputy Minister.
I wish I could go to academia, because you're free there. You can say whatever you want to say without any consequences. So
Those are very, very
I-
salient points, and particularly around the emphasis you made on the evaluation of having an adequate ROI for attracting private capital towards infrastructure. Vio, perhaps from your side, obviously there's, with what Ghulam presented in the morning, the global environment, we're seeing a bit of a shock in terms of development financing and the risk of that drying up towards many African markets, which potentially implies that many African sovereigns would now have to, against already constrained balance sheets, increase expenditure on healthcare, let alone infrastructure, particularly with the US aid funding, drying up. In your world where you sit, obviously you reflected upon the importance of pension fund assets or funding, but how big a risk is this for you, or is it an opportunity in some shape, way, or form?
Yeah, I mean, I think it's still quite indeterminate what some of the impacts will be. But I think, again, going back to the South African market and the deep capital markets and deep savings markets, I think from that perspective, South Africa will be largely insulated against any drying up of international development capital, if we can put it that way. Also, I think a lot of the multilaterals that, for instance, rely on support from the US, I think what might happen, rather than necessarily a decline in the amount of capital available, is there might be a change in emphasis. So I think, obviously, a big emphasis on sustainable energy over the past decade or so. I think what's likely to happen is probably a less pointed emphasis on sustainable energy. And these are, let's call it the multilaterals that are supported by the United States, for instance. But I think, at the end of the day, it's about business that makes sense. If investments in certain infrastructure make sense from a return and risk perspective, I think there will be capital to invest in those projects. And if projects didn't make sense in the first instance, then they still don't make sense. I think also collaboration across borders, as the Deputy Minister just mentioned, is also important. Because of the non-monolithic nature and the fact that you've got different risks in different countries. I mean, I look at TRAC, which is part of the Maputo corridor, was a case in point where there was a cross-border deal between Mozambique and South Africa. And in essence, South Africa risk-wrapped the entire project from a contingency perspective. I do think that certain of those types of actions could lead to increased cross-border activity. And maybe just in parting, I think also in terms of getting projects out to market quickly, I think we shouldn't underestimate the benefit of unsolicited bids. For instance, in the network industries, I believe, for instance, user groups are quite prepared to come out with unsolicited bids that essentially encompass a lot of the development work that should go into driving what the projects should look like for the private sector to invest in. So rather than going through multiple RFI stages, for instance, which is what's currently happening, I think maybe opening up the door for unsolicited proposals that help to drive the process forward quicker could be another means of moving things along.
Thanks, Vio. Just as a parting shot, 1 minute each. I know it's a difficult task to do in 1 minute, but Vio, we can start with you. In terms of policy reform and how we can revive economic growth above potential or close to potential in many of our markets in Africa, what are some of the things that you think need to be urgently addressed, or what are some of the things that are already being done that we need to persist with? If we could just compress that in 1 minute, Vio, then go to the Deputy Minister for his remarks in South Africa.
Yeah, I think looking at the markets that are well positioned, the likes of South Africa, Morocco, and to some extent Kenya, I think the development of local capital markets, the Minister mentioned the fact that risk was being mispriced for Africa. I think For instance, on the Lekki project you spoke about, we were able to get Nigerian debt markets out 15 years, and this was 2008, was 17 years ago. And I think that hasn't really been repeated since then. So it's really about building out long-term capital markets in country so that there's a better understanding of risk, and make it easier for domestic savings to be utilized towards domestic projects. And then also just highlighting the importance of scale, repeatability, which allows private sector players to really establish themselves and compete against each other and drive down the cost of infrastructure for end users. And yeah, I think that driving down the cost is what makes it sustainable.
Thanks, you. Deputy Minister.
Economic growth is very important to deal with the macro economic imbalances that we see on the continent, the debt to GDP ratio, inflation, unemployment, GDP growth. So we really have to get our economies growing, and our economies cannot just grow through fragmentation. There's already, Gulem, I suppose you might have spoken about this. I was not here. There's a lot of fragmentation going on in the world. We need more integration of the continent. The infrastructure is a great opportunity to do that. We need an attempt, basically, a synergy of policies. I know in our G20 presidency, we're also working on the cross-border payment, just to make things easier on the continent. And the last thing is that for us to get capital to flow our way, let's not make it difficult, particularly ourselves as government. Let's set up the right incentives for business to come or to be retained, not just to come, because we also have businesses here on the continent. Let's just make sure that we set the right incentives. I'm not allowed to talk about tax. That's the function of the minister. But I'll whisper to him that in certain instances, you might need to do some tax exemption for certain type of infrastructure. But don't tell him that I've said this. It's not within my jurisdiction. Thank you.
Now, with that, thank you so much to our distinguished panelists. It was always going to be a exciting discussion with two brilliant minds. Please, ladies and gentlemen, join me in giving them a warm round of applause. Thank you.
Thank you, Gibran, and to your panelists as well for their candor and insight. And those thoughtful suggestions on policy challenges and potential solutions. I think the regulatory environment they described sets us up perfectly for our next discussion. If you're following the intellectual arc of our conference today, we've moved from the geopolitics to the policy frameworks, and then later on we'll be getting into the structural developments and the energy transition as well. It was interesting for me to think about, while our last panel was on, how much things have changed over the last 50 years. It's easy to focus on how much we have to do and not look at how much has happened. I traveled here from Uganda, and it took me about 4 hours to get to Johannesburg. I was quite interested in how long this journey would have taken 50 years ago. So I did what any reasonable person does in 2025. I asked ChatGPT. And according to ChatGPT, it would have taken me 3 months of trying to get the paperwork and 3 weeks, because I would have had to go to Europe first to get to South Africa. And even in South Africa, I would be restricted to being in only specific areas. I think that really drove home for me how much the right policies and the right infrastructure development can change the lives and possibilities of millions of people in Africa. And that's why these discussions are so important. We've been talking about the policy. Now let's talk about the infrastructure, one of the most significant barriers to Africa's economic transformation. The infrastructure gap. Poor infrastructure is adding 30 to 40% to the cost of goods traded among African countries. That's a reality. Our next panel, Closing the Infrastructure Gap, will explore practical solutions through improved funding access and public-private collaboration with a special focus on logistics infrastructure. And to moderate this discussion, I'm pleased to welcome Adil Kaji, Global Head of Energy and Infrastructure Finance at Standard Bank Group. After heading up project finance until 2018, Adil has focused on infrastructure development across geographies, and his role recently expanded to include African sovereigns as the continent's infrastructure investment gap continues to widen. So Adil, I'll hand over to you to introduce your panelists and lead us through this important conversation.
Thank you very much for that kind introduction. It's been wonderful to follow the conversations this morning as we slowly narrow down and talk about the really key issues. We've heard about this $100 to $200 billion a year of infrastructure financing gap. We've heard about our very well-documented challenges on the continent, poor bankability of projects, a lack of capacity in government and sovereign agencies. We've also heard about the fact that we've got the most youthful population on the continent, a continent rich in minerals and resources, a continent with infinite renewable energy supply. One of the things that we wanted to narrow down the conversation to today, specifically around infrastructure, is to talk about logistics and railway infrastructure. Won't you join me in welcoming my guests this morning? Panelists will help us talk through some of the issues that face us for railway infrastructure, talk through and explore how we unlock funding, and talk through and explore some of the key shifts that are required for us to really move the dial forward. Please join me in welcoming my guests. I'll introduce them shortly. Mr. Raphael Owino, James Holly, Tristan, and Constantine. Thank you. Gentlemen, thank you very much. I wanted to specifically narrow the conversation to the rail discussion. I think one could argue that investment into Africa's railway infrastructure will most certainly drive economic growth by bringing down the cost of cargo. It'll offer efficient exit routes for critical mineral sectors. It'll significantly decarbonize by seeing a lot more trucks off the road. As we know, currently 80% of our cargo is still transported via the road network. And scaling transportation will certainly see more intra-African trade. And so let's explore some of the shifts needed, the roles of the different stakeholders, the opportunity before us, and some perspectives on some of the unlocks required. Raphael, if I could start with you, I think in an instance where this is infrastructure that spans geographical regions, spans across countries, most often owned by governments, what role should government be playing in really creating an enabling environment to accelerate rail sector investment and development?
Thank you very much. I was very glad to hear the Deputy Minister mention in the last panel that the government doesn't have to finance infrastructure. I wish that would happen everywhere, but that is really, really far from the truth. But of course, the government has a much bigger role than just financing infrastructure. The government has a role in formulating the policy that guides the development of infrastructure, that guides the development to link it to the overall priorities of the country, so that as the private sector players are developing infrastructure, then that has to link to the overall priority and development goals of the country. Of course, the government also has a role in mobilizing key players that would come to invest in infrastructure. For example, if you want to do a PPP, you need to get the key players in the PPP field to come and be involved, but also mobilizing other interested parties. For example, in East Africa, in coming down straight to the rail network, we are currently developing a regional rail network, and here the government is playing a key role of making sure that whatever Kenya is doing is feeding into what Uganda is doing and is feeding into what Rwanda is doing, such that the rail line that we are currently developing from Mombasa to the border with Uganda is going to link seamlessly with a rail line that is being developed by Uganda to the border with Rwanda, and then Rwanda takes it on to the border with Kigali. So bringing up that regional connectivity and agreeing on what are the standards that is required for the new railway line that we are doing, what is it that we need to make sure everything aligns to each other. So the government, yes, has a very big role. But even in terms of mobilizing infrastructure, the government still has a role to support. The rail line that I'm talking of, the Kenyan one, the standard gauge railway, the first phase of development, what we did was largely finance that from borrowed resources, largely from China. And that was very, very expensive. So what are we doing going forward? Going forward, we have adopted a strategy where we are going to mix public financing with private infrastructure, so that we bring in private players who will then run the rail line for some time before then handing over to the government after getting their returns on their investment. So we are changing the model because of the experience we have had into a model where the private sector plays a bigger role, not only in running the infrastructure, but also contributing financing to the same. Thank you.
Thank you. Thanks, Raphael. I mean, it is also a sector that requires arguably one of the largest deployment of capital. And so, simply relying on traditional PPP type frameworks and structures would not necessarily solve the problem. How do you see the need for concessional financing, grants, and even blended finance as a solution to really unlock railway infrastructure?
Thank you. Now, the concessional financing players don't seem to look at railway lines as a darling of investment. They more of finance, what I've seen is finance projects such as water and sanitation, direct budget support to the government. But when you want to do core infrastructure such as railway lines, I've not seen a lot of concessional financing going into that. But blended financing has been there supporting these kind of projects. And of course, if you go to commercial financing or semi-concessional, I think that has been available for railway financing and other infrastructure development financing. And I think this is where the international players, the multilateral institutions need to rethink. African Development Bank in Africa has done a great deal in offering concessional financing for road network, but I've not seen a lot of attention to the railway network, which is where now we should go.
Thank you. James, if I can move over to you. I mean, I think we've got a few or a number of success stories to tell on the continent, but the private sector could be described as being frustrated by the lack of momentum or the lack of progress. Would this be a fair comment?
Ideal. I think the answer to that is yes and no. I think, if we use South Africa as an example, where we're going through a really transformational rail reform, no, in that I think in a relatively short period of time, you've had to write a reform strategy and implement a reform strategy for a country that has had a monopoly that's existed for a century, and is one of the biggest rail entities in the world. And that's no mean feat. In the context of collapsing cash flows, over-indebtedness, infrastructure problems, it's a challenging task. And I think where we are today is you've got a strategy for both rail trains, above rail, and infrastructure that makes sense. And you've got a national rail policy that's aligned with subsequent policies that have been released. You've got an economic regulator in place for the first time. So great progress in that sense. We are frustrated in a sense that, we had the release of the network statement in December, and we're just not quite at the point of that being investable yet. And at the end of the day, if you can implement any reforms you want, but if it's not investable, then the battle's not won. I'm extremely confident that we're going to get to a point of investability. Okay, that it's and you can't sort of underestimate the challenge of the journey that South Africa's had to undertake. But we're very close. I do think if you look outside the borders of South Africa, the company that I run is a private rail operator. 7 years ago, we operated private networks in South Africa, and we operated in Mozambique. Today, we operate in 9 countries, and that's because of the implementation of regional rail reform, which allows private operators to access the national network. So significant progress has been made. It's undeniable.
I mean, what struck me as you were speaking is certainly, I think you're right. I think it is something to be optimistic about, particularly around the period of time over which we've seen significant momentum, specifically in South Africa. And I think, when you talk about large-scale reform and you talk about really being able to shift it, what has contributed to it in SA specifically is what you would call a real partnership of all stakeholders. So operators, infrastructure owners, owners of capital, freight owners. I mean, for each of these stakeholders, to kind of drive interest to get to a point that gets us to projects that are bankable is certainly, I think, a recipe for other markets to consider. I want to touch specifically on the owners of freight. I mean, arguably, these could be the biggest key to unlocking a structure that is bankable. Some perspectives on that?
Yeah, Adil, I completely, of course, agree with you. In our world, everything starts with the freight. Okay, you can have the best railway line on earth if you've got no freight. It's of no relevance to train operating companies. Okay, you have to look at the freight opportunity that South Africa presents. You've got Transnet in 2018 moved 226 million tons. Their current annualized run rate is an improvement from 149 million tons to 160 million tons over the last 3 years. But you're still significantly below at 66 million tons below where they were. It's generally accepted that the demand for rail freight in South Africa is about 250 million tons. So that's about 90 million ton shortfall, freight shortfall, as to what's going on, what should be going on rail. And it's important to remember that not all of that goes on road. In fact, a lot of it is a complete economic opportunity forgone. So, you know, in the context of that freight opportunity, there's a significant rail opportunity. And, you know, to put it into numbers, 90 million tons of freight requires more or less 75 billion rand of trains, okay? And then, you know, when you say, well, in order to get 75 billion rand of trains running, how much do we need the infrastructure to be uplifted to get to a condition where those trains are really operating efficiently? And that's more or less about 200 billion that I believe the South African freight network needs in order to get it up to condition. So you're looking at a number of about more or less 300 billion rand that's needed to get the South African rail freight industry into a condition where it's really moving. Your question is, what role do the freight owners play? Well, I mean, they play a fundamental role in getting that unlocked, okay? Because when we make an investment decision to buy one of Tristan on my left's wonderful 23E locomotives that he manufactures in Durban, we make a decision to invest in an asset that on the spec sheet says life of asset 30 years, okay? So unfortunately, when you're making an investment decision of that period, you have to be pretty certain about that investment. It's a very high capital cost item. So in order to really make sense in the environment of high road competitiveness, you need to be able to leverage equity returns. You need high levels of debt. To get high levels of debt, what do you need? You need the ability to generate income from your asset for a long period of time, long-dated access rates, but then you need long-dated commitments from your customers, from the freight owners, and that's the other side of the coin. So when we come to our lenders, which, you know, of course, may or may not include Standard Bank, we go with, you know, two very important agreements: rail access agreement, which is the one that I think needs some work, freight services agreement with our customer, and the strength of that customer ultimately underpins the cash flows that underpin everything.
We touched on, I mean, just volumes of freight, and we touched on the on-the-ground infrastructure. Tristan, if I may, it'll be a good time to kind of talk about, we want to add more and more freight. We know we've got significant shortages of rolling stock on existing infrastructure. It would be interesting to get some perspectives on the role that technology plays in accelerating rail reform.
Absolutely, thanks. So first, before the how, just a little bit more on the why, and you've touched on many of them, but the way I see it is that on the African continent, traffic congestion is going to cost about $500 billion of GDP by 2030. So in just half a decade, you're just talking gigantic sums of money that are just being lost due to poor infrastructure and not enough rail. So a little bit on the how. One of the key pillars is signaling. If you're able to improve signaling in rail, and that's freight and passenger rail, you unlock just a lot better cycle time. If I look at freight, the cycle time between the mine to the offloading point and then back to the mine, you reduce that and you just get massively more revenue. And it's the same for passengers. Currently, there are very good trains in South Africa, the Blue Train, but some of them run at 60 minutes. So if you miss it, you have to wait, 59 minutes for the next one. And there are pretty simple ways and implementable ways of reducing those headways. And I think in South Africa specifically, it would be about using the onboard equipment that's already in the locomotives and the trains, using the GSM radio signals, which already equip a large part of the networks, both for Prasa and Transnet, and really minimizing everything that's wayside equipment. So that's going to be your equipment along the track, because obviously those get stolen, they get vandalized, or you cover such huge distances in the case of freight that it's just very hard to maintain security over everything. But there are ways to capture these, so that's the first piece on signaling. Another piece of innovation or technological improvement lies with many things hybrid, okay? On these vehicles, on these trains, these locomotives, it's not very difficult to equip with a diesel power pack if you're running an electric product, so that if there's a section of the line that's unelectrified for whatever reason, then you can still bridge over to the other side with a diesel solution and then regain some electricity and keep running your operations. You're not stuck for hours and days. There are many other hybrid solutions. There are batteries that can be installed, same if you lose a catenary signal, et cetera, et cetera. We can also install diesel for last mile in a locomotive application. I think the last one is optimizing all of that. So optimizing your operations, and it's a similar industry as to many other industries and people in this room. We are looking at predictive analytics. We are looking at better route management. We're looking at reducing the time for operations, and all these in turn will boost.
I think it's not often, that you talk about sustainability and energy transition in the context of rail and rail infrastructure. I do think, though, that the thought of using rail and improving rail infrastructure as a decarbonization tool for that congestion you speak about on the roads is a really strong factor in mobilizing capital. Is that, some of the rhetoric that you've been seeing in your industry?
Yeah, absolutely. And frankly, we've been seeing it across all continents, but specifically for Africa. Maybe a few numbers to frame what we've been hearing and what we've been saying. Rail is, it emits about 5 to 10 less greenhouse gases than car or plane, and not directly linked, but linked to sustainability, it's also 100 times safer than driving a car, okay? So you have a natural argument. It's almost a green, natively green industry when you talk about rail. And we've been having these conversations. It's also rail. You think about urban centers, extremely congested. There are 50 cities in Africa with more than 1 million inhabitants. And so any piece of urban land is going to get more and more scarce. So you just think of the space that it takes, and installing a heavy rail system on a width of about 3.5 meters, so that's about the width of a road, you carry 40 times more passengers. So you're just in a completely different game in terms of capacity and moving people around. And of course, those same people that get from their home to their work, to their schools, to health centers, to hospitals, they do so at a fraction of their disposable income. Specifically in this country, there are people who spend 40, 50%, 50 plus of their disposable income on transportation. So when you offer, when governments offer solutions which are a fraction of that, it frees up more income for the rest. So yes.
Thanks, Tristan. Constantine, if we can pivot the discussion a little bit now towards capital and accessing capital. Not often an asset class that garners the amount of interest we'd like from capital providers. How would you describe market appetite for rail infrastructure on the continent?
Thank you for that question. Listen, the rail sector is, you've gone through the stakeholders. Your owner of the infrastructure is the government, and all the other players are largely private. The operators, the rolling stock providers, and the owners of the freight, often. And the structures that have been used over the past years have been ones where you are involving private sector in the development of rail through PPPs, concessions, but ultimately, due to the lack of tariffs and other things, the burden of the financing, attracting that debt, has been put on the government. Wonderful model, it works well. We've seen it in Tanzania, we've seen it in many other countries. However, for a debt provider, your credit risk is on a host government, right? And they will, of course, want to borrow the money at mid to long term to match the investment, and therefore they are looking to raise 7 to 10 or 15-year money. And if you look at the last 5 years on the continent, they have been one of a very pressured operating environment, downgrades of the sovereigns, pressures on these, right, FX shortages. So the credit risk that you are taking on a government is high, and this sector is a marriage between the private and the public sector. The other thing is, by making the governments the obligors, which is the right model at the moment, it is considered by many development finance institutions to be a public sector project and not a private sector project, right? So there, your names like an IFC or a DG Proparco are immediately precluded from doing that. Now, what I think, and so how do I get away from this, right? And I think we've heard it on this panel a few times, and we've heard it on some of the others, the previous panels. What is changing at the moment, I think, is the commercial industrial play on the whole continent. With the operationalization of the continental free trade area, we're going to see changes in investment decisions. We're going to see changes in the direction of trade and those corridors. And we at Afrexa Bank are already working at supporting and driving the creation of industrial parks, free trade zones, manufacturing, everything that is linked to export development and value creation. And I think that once you have that, trains don't stop somewhere just because they want to stop there. They stop there because people want to use them, right? And it's not just about driving your chickens to the market. If there's a massive industrial zone there, you're going to build your rail line there. And and you've done plenty of project finance in your life. Normally, it is the developers of the plants that come first. And then one says, okay, you government, I need you to help with the rail line or with water or other access, supporting infrastructure. But that supporting infrastructure always follows that initial value creation or manufacturing concept, right? So I think with this game changer that is coming and the industrial commercial play that I think we're seeing more of, and that needs to be then worked out how you bring that in, I think that is going to definitely change the market appetite that you have already by giving it a more commercial dynamic. Maybe I could just stop there.
Yeah, I mean, I think, the one thing that that always comes up as a key challenge is, one, these are significant quantums of capital required for this type of infrastructure. Your sovereign obligors are often at their own limits in terms of ability to take on more liabilities on their balance sheets. Sovereign agencies that are in charge of rail have similar issues. And so as providers of capital in the market, the type of partnerships we need to start developing with MDBs and often with global export credit agencies start becoming more and more critical. In your experience, are you seeing these agencies have more appetite for this type of infrastructure, have more innovative ideas around credit-enhanced structures that can help us unlock more capital for railway infrastructure?
Absolutely. As I said before, of your 4 stakeholders, 3 of them are largely private, and a lot of them are ex-African as well. So if you are exporting goods and services from France or from China or the US or anywhere, your export credit agency is going to be key because they are there to facilitate the export of goods and services from that country that is exporting into Africa and into these specific projects. And that is, you can have that for rail and you can have that for rolling stock. The ECA is a key. And I think we are seeing more innovative structures there. right? The ECAs can do the typical cover for the exportation of goods. We, as development finance institutions, are also using the ECAs through on-lending structures. So not standard bank, let's use a different example. A Japanese bank will lend money to Afrexim Bank or to TDB or DBSA under Japanese ECA cover. That gives us access to cheaper funds and longer dated funds, and we will then on-lend those into in this case, a rail project. If you look at, for example, the Tanzania rail project, you had a lot of the African development finance institutions lending into that, but we all received on-lending lines from development finance institutions and MDBs to bring down the cost and our ability to lend longer dated money into that project, right? I think one of the issues I'm seeing, though, is that some of these ECAs, their limits on these countries are filling up, right? So there are ECAs who will say, I'm sorry, I can't do any more Angola, I can't do any more Nigeria. And then that drives you to on-lending structures, right? But that means that Afrexim Bank or the other DFIs are carrying more risk, right? And that needs to be spread a little bit more, right? And so I think that is one of the things that needs to be unlocked a little bit. And then obviously there are plenty of guarantee providers. There are the whole insurance market that you've invited today also play a critical role in de-risking. Right? There's two elements. One is bringing down the cost of funds, and the other one is the de-risking element. The one thing I must say is we're very smart at doing this now. We all know each other. To have the insurers in the room, the ECAs in the room, the DFIs, the commercial banks, we've all got each other in our phones. We've done the financing structures before. It's so the ease. There's an ease of bringing these pools of capital together, right? But at the end of the day, most capital is following some kind of economic interest.
Yeah.
The Chinese banks don't finance a rail project in Africa unless it has Chinese content, right? And it's the same for the French or whatever. So, and I think that works. And I think it just needs to be rolled out more, enhanced when it will. And I think the partnerships are there.
Yeah. I mean, coming back to the partnership point, Raphael, if you could swing back to, I suppose, ministries of finance, government, owners of infrastructure, we're hearing that there isn't necessarily a shortage of capital. There isn't necessarily a shortage of tools to unlock capital. What would you think are the key impediments that are currently not giving us the momentum we need from a policy perspective?
I think one key impediment is the perception that the investors have in terms of the risk. I think the investors seem to have placed too much a premium on the risk in investment in some of these projects. And I think they need to be looked at differently, because that perception of risk is making the cost of investing in these projects very high in terms of financing costs. So if we could have projects looked at in terms of individual risk that they pose. A railway line, for example, I think it's an piece of infrastructure that any investor would be sure of getting their return back. And therefore, the risk associated with this type of investment is much, much lower. And this is where I think financiers should relook at and provide financing at a reasonable cost compared to investing in other types of risky infrastructure.
Thank you for that. I mean, James, maybe some parting shots, right? I mean, we arrived here this morning to some, I think, fairly positive news in SA. We've obviously been closely involved with the reform story. Requests for interest have come out this morning. As a private sector player, and Tristan, for you as well, that type of news, what does it start signaling?
It's hard to sort of exaggerate what a game-changing moment it would be if the South African government is successful in implementing those 3 projects. It really is, you're talking about each of those corridors would be a logistics business on its own that's bigger than the biggest private logistics businesses that are listed on the Johannesburg Stock Exchange at the moment. And it's not really you know, we keep on trying to remind ourselves in the rail industry that we actually are not industry. We serve industry. We are a network that serves an upstream economy. And you know, in South Africa, you've got an upstream economy. We've got 1 in 3 people out of employment. And that's the problem you've got to solve. You've got to solve for how do you create a network industry in South Africa out of the railways that is competitive enough to stimulate an upstream economy to create significant growth, okay? And what we have, the reason why, as Traction, we have been optimistic about South Africa's rail prospects for some time, since government signaled what they were going to do, and they're doing it, which is very important, is that the freight exists. It comes back to your first question, Adil. The freight exists. You know, when you look at the iron ore line and the manganese, the iron ore line from Sishen till Saldanha, and manganese down to Kuche PE, the freight volumes that exist for standalone financial feasibility, okay? When you look at the northern corridor, which brilliantly has been extended not just from Ermelo or from the mines around Ermelo, it's been extended into Limpopo, so you've got a complete system. The freight volumes exist, we believe, for standalone financial feasibility. Now, the power that represents for an economy is huge because you don't have to constrain the fiscus by giving underpins to get those projects away, and the economic uplifts upstream are significant. The third project there is the intermodal project, which is very widely scoped, okay? Parts of that I don't think are standalone financially feasible. But if you can get, back to concessional funding, if you can get a World Bank hook, and I know that comes with government guarantees, if you can get a World Bank hook onto those projects, it changes the game, and those projects become unlocked. All of a sudden, okay, all of a sudden, you've got a scenario where South Africa's logistics is globally competitive. And what does that mean for our economy? I think it's significant.
Yeah. Yeah, I mean, I think the one thing that comes through over and over again, and we can talk about, you know, capital pools and policy reform, but the kind of baseline theme across infrastructure development, whether we're talking about roads or rail or free trade zones or manufacturing, is this multiplier that comes with it for economies. And I think that's really you know, what we're after on the continent. Thank you for this insightful discussion. Ladies and gentlemen, my panel, Constantine von Molk, EFRI-XIM Head of Syndications and Risk Distribution, James Holley, CEO Traction, Mr. Tristan Lamar, Alstom, MD, Southern Africa, and Rafael Otieno, Director General, Debt Management Office in Kenya. Thank you so much. Appreciate your time, gentlemen.
Thank you very much, Adil, and your panelists for that illuminating discussion focusing on rail development and infrastructure around the continent. Insights providing concrete pathways towards addressing that deficit that was mentioned earlier. I do want to flag that there will be an opportunity to engage with some of the different countries you're going to be hearing from in our sessions. That will be tomorrow. So do have that in mind. Keep your questions. There will be opportunities to interact directly with the representatives of those countries. Now, we're going to focus on Tanzania for a little bit next. Tanzania is a country where economic transformation presents specific opportunities in agriculture, in manufacturing, and in tourism, supported by ongoing reforms to improve the business environment. Tanzania's journey illustrates both the challenges and the potential of structural transformation, with particular relevance to infrastructure, which we've just been talking about, and financial market deepening. Our next speaker is going to provide some insights into Tanzania's vision for addressing these opportunities and for navigating its development path forward. So please join me now in welcoming our speaker to present the vision for Tanzania, Mr. Yamungu Kayandabila, Deputy Governor of the Bank of Tanzania.
So thank you very much for inviting the Bank of Tanzania to this wonderful, conference by Standard Bank. I don't know how many minutes I have, but allow me to give you a bit of macroeconomic indicators of Tanzania. By the way, for those people who don't know where Tanzania is, we are close to Kenya. And my brother Otieno, when he was mentioning about railway, I think he forgot to talk about Tanzania. Yeah, but speaking of the railway, for example, I don't know, in Africa, we are implementing a 2,000 kilometers of standard gauge railway. This is Tanzania. I'm repeating, 2,000 kilometers. And we are only halfway. So, a lot of opportunities. Now, coming back to because I'm, from Central Bank, I think you would want to hear, what are we doing in the macroeconomic picture? Well, I think you know the numbers. We are growing at, currently at 5.4. This was our last year, annualized growth. This year, we project 6%. And mind you, this is not our trend growth. Actually, our trend growth is 7%. And we look forward to that. Our inflation is, I don't know, I'm told, I think we are one of the best in the world. It's 3.1, 3.2%, this inflation. Our current account gets the number. I think you know it. It's also very good, less than 3%, 2.7. So, we have been talking of debt to GDP, debt to GDP. Even with this massive public investment we are taking, our debt to GDP is 41% of GDP. So you see, we still have a buffer. So please come to Tanzania. Yeah, so I'll go on and on, but really, I think you have been following our president, Her Excellency President Samia Suluhu Hassan. I think confidently, I would say she's pro-private sector growth, economic growth. She's advocate of private sector-led growth. So she has been, pushing us in the, in the civil service, as technocrats, to make sure that we don't really let her down. We have to push this, dream she has. You remember, I think you also participated in January. We had, this big summit, energy summit, Mission 300, She's a champion of cooking clean energy, So we had this, benefit of, hosting that a big project. So, what are we really doing? Of course, our vision 2025 is ending this year, so we are preparing another 20-25 years, 20-50 years, where we want to position Tanzania into a more upper middle income. I know South Africa, you're already there. So we have this big dream, but as a country, we know we cannot do it alone. We have to go, with the private sector. So really, a lot of opportunities, if I may tell you that, be it in manufacturing, in agriculture, construction, you name it, energy. Yeah, please come. Solar energy, wind energy, you name it. We have plenty of sun in Tanzania. And the wind too. You see, I know South Africa is big, but Tanzania is also big, physically. Yeah? You combine Kenya, Uganda, Rwanda, Burundi, then, Tanzania is still big. So please come. My brother Otieno can testify this. So really we have a lot of opportunities for private sector to work in, and what the government is doing in terms of infrastructure. Now we have a PPP center, I hope you have been also following this. We are now, we have floated a tender, from in between, from Dar es Salaam to Morogoro. So this will start from somewhere in Chalinze, where our fourth president comes, President Kikwete, to Morogoro, close to, 200 kilometers. This is looking for you guys, yeah? PPP, Roto, So we have a lot. On food security, again, we would want to see farms, big farms. By the way, I don't know if you know, in terms of cashew nuts, maybe you know Ivory Coast, Nigeria. If you Google there, you'll find actually compete with those two. Cashew, I think we all know cashew, But Tanzanian cashew has the best aroma in the world. But all these years, we have been, our farms have been, traditional. So please come, so that you join us and you get money, you invest and get money, and us, we also get some, our people, young people, get employment and everything. So we have a lot. You have heard of port modernization. All this, the new Bagamoyo port, it wants you, So all these projects are ready. Please, I know my time is up, but we have our wonderful Tanzania Investment Center, which, is very active now, very robust. You can just, Google and you'll see Tanzania Investment Center. If you want any fiscal incentives, you'll get them there. So once again, maybe I would want more time, but I think we have tomorrow, the bilateral one. So thank you very much for giving me. Thank you, sir. Thank you.
Thank you very much, Deputy Governor. And absolutely, there's more time tomorrow if you want to find out more about the aroma of Tanzanian cashews. That's the best time to do it. Deputy Governor, thank you so much. And of course, there'll be an opportunity to speak to all the different country representatives that you're hearing from as well in our breakout sessions tomorrow. So just a reminder for you there. So now we're going to turn our attention to perhaps the most fundamental enabler of Africa's development, energy. Africa's energy sector stands at a pivotal crossroads, balancing urgent development needs with global imperatives for sustainability and climate action. We keep hearing that number of people who do not have access to energy in Africa, 600 million. Well, our next panel will explore strategies to accelerate investment in energy infrastructure across the continent while addressing that critical balance between the existing baseload capacity and renewable alternatives. For that, I'm very pleased to introduce our moderator, Rensha Van Tonder, Head of Power at Standard Bank Group. Since joining Standard Bank in 2014, Rensha has focused on developing opportunities for the bank to become the leading funder of renewable and power projects across Africa. Rensha, I'll hand it over to you for introductions.
Thank you. Thank you, everyone. I said to myself, I'm not going to mention the 600 million people at all, or the $70 billion per annum that we need to change the shape in Africa just in energy. So by saying that, we will definitely have a very exciting discussion today. I'm not the expert, but I'm joined by 3 experts today. So I want to invite Marcel, Alberto, and Tente to the podium as a brief. I had to bring in an Afrikaans word because you're in such a beautiful part of our country. So welcome all of you. Can you all join me? Tente. Thank you all. I want to start by just mentioning to you the importance of the sector on the continent. And again, at Standard Bank, we believe that it's not about only one technology or one solution, but especially our presence countries to understand through having a deep sector knowledge, flexible opportunities in flexible technologies. And how do we unpack that? I first want to ask my panelists just to do a brief introduction of the companies they represent. You will see we're trying to cover a bit of different worlds that we touch as a bank. So I want to start with Marcel and then go to Tente and to Alberto. Thanks, Marcel.
Thanks, Brenda. I'm Marcel Brühwiler. I represent the International Finance Corporation, the private sector arm of the World Bank Group. I'm working out of Joburg and covering infrastructure investments in Southern Africa.
Thanks, Marcel. Tente.
Thanks, Rensha. My name is Tente. Second name Tente, middle name Tente. I don't know what I've done. For my sins, I find myself amongst the financial experts. By profession, I'm a civil engineer and currently the chief executive of the Lesotho Highlands Development Authority. Thank you.
Thanks, Alberto.
Thank you, Rensha. My name is Alberto Gambacorta. Scatec is a renewable energy solutions company based out of Oslo in terms of headquarters, listed in the Oslo Stock Exchange. We have developed, built, owned, operated, and we are in the process of structuring about 7 gigawatts worth of projects, PV, wind, BESS, hydro around the world. And I'm happy to report that more than 50% of that is actually in the African continent.
Thanks. So I want to start with kicking off this conversation. It's not only about energy transition, it's about energy security, access to energy, and actually making a meaningful impact on this continent. And as we said, it unlocks so much more. So I want to move to Marcel first. I mean, the IFC has played such an important role, not only in our presence countries, but across the continent. Can you give us a sense of how far are we actually down this line in terms of unlocking opportunities in energy transition, and what does it mean for the continent?
Well, in short, progress still leaves much to be desired. You mentioned it in your introduction, Rensha. The number of people without access to stable electricity on the continent has been on the rise, actually, in recent years, which is pretty depressing. And it's basically still the same old story which hampers investments. It's the combination of lack of cost-reflective tariffs, ailing utilities, some of them even with negative operating cash flow, very high transmission and distribution losses, and this in situations where, you know, there's also some countries have surplus power generation, and the wires are not keeping up, so the power cannot be evacuated, to the extent that now even Bitcoin mining groups are coming and say they want to use the power to mine Bitcoins, when the country only has 40% access to power. So I don't know. It's not the environment where private sector really comes and invests, and so the only really thriving markets for private investments in the power sector, frankly, South Africa and Egypt. You know, in the rest of the continent, not that much is happening. Now, you mentioned from generation to distribution to, well, transmission to distribution. We had, I think one has to say, experiments with private distribution on the continent, Uganda, Cameroon and Nigeria. All of those private utilities are failing, but frankly not because of the fault of the private sector investors. There are policy issues, there are political economy issues, and there's also the government part who is not really coming up to their side of the equation. So all of that is pretty, well, not really encouraging. Now, what's the green shoot here, right? The green shoot is that technology, and I'm sure we're going to hear more from Adalberto, technology offers more than just grid-connected power. About half of the unelectrified Africans need to be connected through so-called distributed renewable generation. So this is your solar home systems, your mini-grid, but also your commercial industrial PV, which the government has much lesser role in. It still requires enabling regulatory framework, but much more direct control of the investor to get into that. And I'll speak about that a little bit later, but I'll stop here for now.
Thanks. I just want to quickly latch onto one of the questions of one of the issues you raised. I mean, it's the importance of government regulators creating enabling environment. To what extent do you find the role that you play in some of these countries as key? Is it positive? Do you need more assistance? Do you need partners?
Is that a question to me?
Yeah, sorry, Marshall. No, it's a follow-up in terms of you framed some of the challenges around regulatory enabling environments, governments, unbankable utilities. So the question is, how do you navigate through that, and what role does the IFC play in unlocking some of those challenges?
Yeah, so you have mentioned Mission 300. So Mission 300 is an initiative launched by the World Bank and the African Development earlier this year in Tanzania. And this is, for me, a really positive momentum. So 12 countries across the continent have signed so-called energy compacts, which are short 10-page documents which outline the reform agenda to allow for more private sector investment. It's not only private sector investment, we also need stronger utilities, public sector utilities who can run transmission grids, distribute power, or last mile distribution in the cities. But quite evidently, the capital required on the continent in the electricity sector cannot come from public sector. The official development assistance is a drop in the ocean. There is not that much around anymore. And it's getting more and more difficult to find donor funds in a new geopolitical environment. On top of it, as we know and as we heard from the government, fiscal space is very limited. So this Mission 300 and these energy compacts with the countries, I find quite encouraging. I also realize, or let's say my public sector colleagues in the World Bank and also in the African Development Bank, they have more and more realized that in order to make progress in the electricity sectors, they need a counterparty who can implement. With utilities, many of them, frankly, being largely defunct, they lack that counterparty. So they need to now find ways to electrify Africa through the private sector. And so this gives us more momentum than we had ever before, I believe, for the next decade to really make progress.
I agree. I'm also excited about Mission 300. I want to move to you, Alberto. I mean, SCATEC and the track record on this continent is unbelievable. I mean, it's just for Standard Bank, it goes back more than 10 years. And I think if you look at the meaningful impact the projects have, not only in this country, but in other countries as well, can you give us a sense? And I think many of the audience members today don't fully recognize or know the names. So maybe give us a sense of what you've achieved as a company and how did you manage to do that? Thanks.
Thanks, Renche. So I know this is a crowd that likes numbers, so I'm going to use a few numbers here. Let me start with the second part of the question, which is why Africa? Why and how did we move here? Well, we started off as a startup, pretty much, in Norway. And there isn't that much sun in Norway, so you can blame it on the polar nature or polar explorer nature of Norwegians or the executives that have some experience in oil exploration, oil and gas exploration in the continent. But we very soon had to make a decision. Where are we going to use our capital? Where are we going to deploy our capital? These projects are capital intensive. And we make very quickly a decision to move into high-risk, high-reward markets. And these are the emerging markets. So we sold all of our assets in Europe, almost all, in Europe and the US. And then we decided to invest in this continent, starting from South Africa, where we participated in the first REAP project, and we were awarded our first project, the 75 megawatt Kalkbolt. And thereon, it's been a story of successes both in South Africa, Egypt, Rwanda, Mozambique. I'm sure I'm leaving quite a few out of the picture, Tunisia, and then later with the acquisition of SN Power, even hydro projects in Uganda. And then smaller projects like South Sudan with our release projects, or Cameroon with a release project. And this amounts to roughly $3 to $4 billion in investments. Now that's a good 600 to 800 million in equity and about 3.2 billion in financing. And this came through both commercial debts or blended finance, including the IFC. So this is a story of about 15 years of development and construction in the continent. Now, why did we choose to move to Africa? Well, it's partly DNA, as I just discussed, and also fundamentals. We heard it before. To power the growth in the country, in the continent, you really need a lot of energy. So the fundamentals looked really good. Just in South Africa, we're looking at a 50 to 70 gigawatt opportunity in renewables. That's enormous. The third part, I think you touched upon that, Marcel, and it's regulation. We found a certain level of policies and rule of law which is conducive of developments and construction of these assets. They need to live for 20 years. They need to have power purchase agreements that have some sort of government backstop. There's some sort of policies that are conducive for these assets. And here we found, especially in South Africa, with the repeat of the REAP program, the battery energies program, the risk mitigation program, we found it conducive of us developing our first solar projects, the first hybrid power plants, to date still the largest one in the continent, the first redeployable leasing solution for the UN refugee camp in South Sudan, and now also with the utility in Cameroon, as well as our first trading and aggregation platform in the continent, which is our Lara project. Then, of course, to enable all of this, we needed capital, and that's with partners like Standard Bank and the IFC. I think we always say in the company there's never going to be shortage of capital for good projects, and that's been true for us in Africa. So deploying those $4 billion between equity and debt, it has actually happened because we had robust projects and robust frameworks behind them. And then the human capital. I'm happy to report that our office in Cape Town is larger than the one in Oslo. We employ about 300 people, and we serve our operations globally. So this is as much an African success story as it is a Norwegian success story.
Yeah, I think you've mentioned a very good point, and I always say when we are challenged for bankable projects, the capital will come if you have those projects ready, and I think Adil mentioned it on his panel as well. I think what we do need is more patient development capital, more patient equity, because sometimes it does take just too long to get the projects to the point where we can actually proceed. And I'll get back to how do we get across that hurdle just now, but I want to move to Tente, and it's so interesting when we talk about Lesotho Highlands Authority and what you've achieved there and the experience. So I want to ask you just to share also some numbers with the audience, because when you and I spoke, it was like blown away. It is unbelievable. It also took quite a bit of time, but you managed to get there, to navigate through the process. So maybe share that winning formula with all of us.
Thanks again, Ranshia. I think maybe to provide context, I need to explain the geography first.
Yeah.
Because Lesotho is right in the belly of South Africa. So you need to understand that if you have something in your belly, you have to nurse it around, otherwise you will have problems. The Lesotho Highlands Water Project is a result of what we call double coincidence of needs, where if you look at the Gauteng region, the Gauteng province, Gauteng in Sesotho is gold. It's a city of gold. Usually, right around the world, before a city can be established, you need to confirm the source of water. In the case of Gauteng, that was not the case. The gold determined where the city needed to be, and the water had to follow the city. That's what led to the Lesotho Highlands Water Project, as the industrial sector needs in South Africa were rising and the household needs for water were rising. Then South Africa needed to meet those demands. On the other hand, Lesotho was looking for opportunities to earn revenue and to be independent in energy production. So hence the double coincidence of needs. So you asked me about the winning formula. I'll mention quite a few, but it's not limited to only those that I will mention. One of the first one is collaboration, because the rivers emanating from Lesotho flow through a number of countries, and critically, let's mention the Orange River, which flows through the riparian states, being Lesotho, South Africa, Namibia, as well as Botswana. So that respect for the rights of the riparian states is one of the critical success factors in this formula. And when the treaty was signed back in 1986, there were clear objectives and responsibilities codified in that treaty, which clearly defined the institutional arrangements as well as presentation in terms of settlement of disputes. So we often refer to the treaty because it came at a time when Lesotho was under the military rule, South Africa was under the apartheid rule. So it survived a number of changes in government in both countries. So often we refer to the Lesotho Islands Project Treaty being well ahead of its time because it's still valid even right now, it's still relevant right now. The other key success factor would be the rules of engagement. The bilateral organization between the two countries works more on consensus basis, not necessarily on a financial muscle that one country has. As we can imagine, Lesotho versus South Africa, that wouldn't work. So the decisions are made on the basis of consensus. And for ourselves as the LHDA, as the implementing agent, our decisions are based on technical requirements because we are supposed to remain neutral and not favor either of the parties. The final one, like I said earlier, is the settlement of disputes. Really, it's willingness to engage, the mindset of win-win versus win-lose situation. There is always no beaming victor or no bitter loser. There is always an effort to strive for more common destiny, common goals that the two parties are striving towards. And the project has been into being for almost 40 years. We'll be celebrating our 40th year next year, and we've never been to arbitration or any of that. Many countries across Africa where there are shared rivers and the likes have been to Lesotho to try and find out about this particular winning formula that you're asking me about. Thank you.
Thanks, Tente. I just want to follow up, but I mean, reaching this success now and 40 years, what next? Do you have a plan? Do you have more opportunities for all the investors in the room? What?
Yes, indeed we do. Like I said, we are a special purpose vehicle, like our sister company in South Africa here, which is meant to implement those projects in the water sector that are able to be financed off the government balance sheet. So the government takes care of social programs and we deal with the capital ones. So there is opportunity in that sector. We are currently in the second phase of the Lesotho Highlands Water Project. It has two components. The one component is for water transfer to Gauteng, and South African government is fully responsible for funding of that particular component. Currently, it's projected at 50 billion rands, and the other component of phase 2 is in the energy sector, where Lesotho is supposed to implement another hydropower project costed in the region of about 30 billion. So we are currently involved in about more than 80 billion rands situation. What's coming further than the renewable energy that I was speaking about, the hydropower, is also we are venturing into the space of solar farms, because we have all this water surface providing an opportunity for solar panels to be placed on that unused water surface. So there are other opportunities for investors. So for me, I'm saying watch the space. There are lots of opportunities to invest in this. And what we're using is a model of PPP, public-private partnership, where we're looking at several blends and mixes in terms of funding that's available. Currently, the water transfer component, what we have the DFIs as well as commercial banks funding the 53 billion that I spoke about. The 30 billion that's coming, we're still out in the market searching for potential funders for that.
Thanks. Thanks, Tente. I see. I want to come back to points that have been made and raised quite a few times today, and that's government support, government commitment, whether that's through funding or guarantees. We know most of the sovereigns in our presence countries and across Africa are actually under pressure. We know that it's not only about generation, it's about transmission as well as distribution. And I want to bring it a bit closer to home and what we're currently experiencing here. And I think the conversation when you talk about energy unlock and the role of transmission is absolutely critical. And it's not only an issue for a specific country, it's a regional unlock, it's a regional story. And I think part of Mission 300 that Marcel referred to try to facilitate that. I want to, Marcel, ask you around, and the Deputy Minister mentioned that as well, this guarantee structure and support to sovereign, to crowd in private sector, private funding. I mean, we've seen the reduction in REAP guarantees from government. We know the sovereign is under pressure. We know that transmission is becoming absolutely critical to unlock more generation. Can you maybe just touch on the role that the IFC play in facilitating and unlocking some of those markets?
Right, so this credit guarantee vehicle, and Deputy Minister Masondo has mentioned it, we're working on this with government as the World Bank Group. So, but let me start by saying such a vehicle, which would relieve the sovereign from providing a backstop to investors, is only a temporary product. Eventually, South Africa needs to transition to a national transmission company, which is bankable on itself. There's a regulatory framework on which, lenders and institutional investors will invest because they know the revenue of the national transmission company in South Africa is regulated and is secure. Now, we're not there yet, and we need to further liberalize the market. So in the meantime, because fiscal space is very limited, there is this project of this credit guarantee vehicle, which is a blended finance vehicle, which is capitalized by junior equity and senior equity. Junior equity partially from government itself, but then also from concessional funders. Now, there lies the probably biggest challenge, to find enough concessional funds so this guarantee premium which the vehicle will charge is competitive and attractive enough. And in today's world, that's not easy. Although, as far as I'm concerned, the narrative, which is an energy transition narrative, you know, to build more renewables, to gradually decommission coal, is still a narrative which in at least some parts of the world is being heard. So I hope that we will get this together.
Absolutely. I'm very excited about the opportunity and the need to work together. I want to move just quickly. I know we've got a few minutes left, and I want to touch on this whole liberalized market that we see developing in South Africa, and it's something that we as a bank are extremely excited about. We do believe that you're going to see more and more of an open market access across many of the countries we're currently present in, and we've seen it in Namibia, we've seen it in Zambia, we've now seen legislation in Kenya opening up, but in South Africa, it's been quite a trajectory in terms of fast-tracking the development of CNI and opportunities around that. I want to move to Alberto and the role that SCATEC see and the opportunity in this change in the market. I mean, we do see that there's still an emphasis on government-procured programs, and a lot has been said about REAP, which we've been very active in, but more so lately with the regulatory changes, opening up the opportunities for traders, aggregators, multi-market, many-to-many view, mentioned it as well. How do you see that for developers and growing your opportunity set?
Thanks, Richard. It's only 2 minutes. It's going to be very difficult, but I'll do my best. So if we look at not just South Africa, for instance, in Egypt, we have our first ammonia purchase agreements, for instance. So we're not just supplying electricity, we're actually supplying ammonia or hydrogen to the off-taker. And in South Africa, with the aggregation platforms and the trading and the liberalization of the market, you will see more and more of this type of opportunities where you are going to have off-takers coming to you for a certain volume, a certain profile, a lot of flexibility. That's the word that we'll see more and more coming up. You'll need to serve them with a certain time of use. You will need to provide to them a certain level of security of their supply. At the same time, you'll need to work together with the transmission company and the distribution companies to make sure that the grid is balanced. So the liberalization is coming probably a bit late in South Africa, but it's a good thing that it's coming because we're going to need a lot of that. And the opportunity for companies like ours, it's enormous. You have a market of off-takers that is in the tens of gigawatts. You have opportunities in the wholesale market that we see in other markets where we operate, like the Philippines, where we operate purely on ancillary services, intraday markets, and that's a great opportunity. So this is all coming to South Africa. So it's not just the generation, not just the megawatt. It's the quality of that megawatt and the attributes that are attached to that megawatt. And remember that carbon tax and all the CBAM threat is actually accelerating that transition for many companies. So the opportunity is great. Of course, there's a lot of competition out there in the market, but that's the right thing that we want to see.
Thanks. I want to ask my panel members, we've got a few seconds left. I know our time was cut short, but just a last concluding remark around what do we need to unlock more funding, more equity investment, and maybe more patience in terms of dealing with this massive opportunity. So let me start with Tente. You, in the middle, you've done a great project, got a great track record. What do you think?
I think for me, one of the things that is important is to think about sustainability. We don't have unlimited resources going forward. We need to think about the future generations as well. So if we can tilt towards renewables and the likes to ensure that there is sustainability going forward, that would be a thumbs up for me. Thank you.
Thanks, Tente. Alberto?
You mentioned collaboration earlier. I think there's a lot of collaboration. There's quite a lot of partnerships, like the one we've had with Standard Bank, with AFC. It's a great story. It's a great partnership. It's a great collaboration. To make all of this happen, it sounds easy, but actually requires quite a lot of work with institutions, with government, with regulators, and with the commercial partners.
Michelle?
One is the policy, and South Africa is leading the way. We need much more gradual market liberalization across the continent. And two is the little concessional funds we have left, we need to use much more strategically. We need to use them in order to mobilize much more private sector capital in the form of, through the form of guarantees, or junior capital, first loss capital, which then has a multiplier effect to get more private sector capital into the market.
Thanks. I couldn't agree more. Let's unlock, let's leverage, let's do more, and let's not only be patient, but try and fast-track the implementation which we need on this continent. Thank you for joining me and thanking the panel members. Really appreciate it. Thanks.
Thank you very much, Renche, and your panel. It is now time for lunch, but just before you go, a quick note. When we return from lunch, we will have that conversation between Luvuyo Masinda and Sir Tony Blair. We'll need to be back in the room and seated by 1:55. So please make a note of that. You've got two options as you go for lunch. You could go to the lawns, or you could go to the avant-garde venue, which is to the left. Hostesses will guide you. We look forward to seeing you when you get back. Enjoy your lunch and your conversations.